Thanks for tuning into Talking Point Unfiltered. These are, well, actually difficult to call unfiltered times simply because there's so much of news flow which will continue in the month of April that it becomes difficult to predict the near term at the very least, even if the long term could be predicted. But we get somebody who thinks really long term on the show today to try and understand how does he think through this, because our guest Prashant Khemka looks at both the global picture and local picture with equal aplomb. Prashant, so good talking to you today.
Pleasure, Niraj. Thanks for having me.
No, the pleasure is entirely as I must tell you. And I don't envy you at all, simply because it's a hot seat to be in, considering all that's happening in the world, particularly from the US side. So, can I start off by asking you, Prashant, that, 2025, Jan 2025, when I was in Davos, everybody predicted yet another year of US exceptionalism. And it's been anything but that. What, is this an aberration, or could we finally see US exceptionalism ending?
See, I think all these narratives are dictated by the market. So, what happened in January 25, or what was the market doing in January 25, was that US market was coming off of a very strong year last year, right? And the year was strong, I think, partly because market was already anticipating Trump to win. Yeah. Now, what's happened over the last 3 months? US markets are off by 10%. 10% is all it takes for narrative to change. So if nothing else in the world changes and the market, US markets, since we're talking about US, are back again, up like 5 to 10%, the exceptionalism would come back. Yeah, but so far year to date, US is trailing other markets like emerging markets, which I'm more daily on top of, are up like 3% or so, 2%. Yeah. So US has underperformed by 12%. After a long time, that's happened. So all of a sudden, US is no longer exceptional. So all these things, seen it forever, they follow the markets.
Follow the markets. Well, okay. So let me try and ask you in a different way. 2024, China market for a lot of people were branded untouchable, right?
Absolutely.
Suddenly, come December, and since then, China has become a hotbed of global activity as well.
Yes.
How difficult does it become to predict um, what you yourself will do in your funds in terms of allocations, etc.? Let's say in your gem fund, right? Or if you're a global allocator, how difficult is it becoming?
It's actually always been very simple.
Okay.
People just making so I first started managing emerging markets at my prior firm in 2013. So clients were like, it's so difficult. How do you take these currency calls, country calls? You just don't need to take these calls. That's the right way. Money is not made. I haven't seen anyone consistently make money over long period, other than the coin flip probabilities. Yeah, because even coin flip, nobody knows how the coin would flip, but 50% would be right. 50% of the times, everyone would be right. Yeah. The same way, those who take currency and country calls, they're right 50% of the times over long period of time. We don't take country or currency calls at all, but just like we do in India, pick stocks bottom up perspective. We may have negative view on macro. So in China, we've had, I think, for a long period of time, a negative macro view. But we tell our clients, we go out of our way to ensure that our macro view is not reflected in our portfolios.
Okay.
It sounds very odd, right?
Yeah, it does.
Yeah, but money is not made in the macro according to us. Macro is a source of risk. You understand from a risk management perspective so that you are not accidentally exposed to a certain large risk.
Okay.
What I mean by that is, now it's not going to happen, but let's say you are accidentally exposed to, in your portfolio, disproportionately to companies who are exporting auto and auto ancillaries and other manufactured goods to US. When I say disproportionately, what it means is, let's say the emerging markets benchmark has 20% of the benchmark in such companies, 20%. And let's say you are 80%. Then that's a subconscious, huge macro risk you are carrying, which is not prudent from a risk management perspective. Even though you may say, oh, I don't care for macro, we are doing it from a bottom-up stock selection perspective. But end of it, you are carrying a macro risk. So there are two ways that this kind of 80% exposure compared to 20% exposure can develop. One is you proactively make a top-down bet that none of these tariffs are going to materialize, the markets are wrong, they've beaten up these stocks too much, and we are going to take 80% weight. That's a top-down bet, recipe for disaster over time, in my view, but that's a top-down bet. The other is you're saying, oh, we just don't care for macro much. We are stock selection wise. These are the stocks that we like. And that ends up having 80% exposure to US. Both have macro risk. In our view, it's important to guard against such risk. We don't think the former is right, meaning that you can make money by making such bets. But the second is also wrong in ignoring the risk.
Yeah. So आप second follow करते हो per se,
Yeah.
but you married with the macro so
Risk
that
management.
you can
Yeah,
manage
so
the
that
risk.
we don't end up having some such risk just because of a stock selection bottom-up approach basis. So to your earlier question, whether, first of all, world has always been as volatile or more as it is today.
Okay.
Now, it has always felt though it is more volatile today than ever before.
True.
Or uncertain.
Yeah.
If you go back, you've been doing it for a long time. Just think about how many times you might have asked people this question. Yeah, but that is true for everyone. Our clients also ask the same thing, as if today's volatility is something different. Now remember, we are all worried about Trump, COVID, which is the biggest disaster of everybody living, or 5 years old and all. Yeah. Can Trump, or whatever Trump does, in its worst manifestation, come anywhere close to the damage caused by the pandemic, COVID? Just few seconds, if you think about it, you'll realize that nothing Trump can do can be as bad as what COVID cost. Yet, through the COVID, and don't take the COVID bottom, take January 1st, 2020, and reflect back and look at just the returns around the world. They've all been double-digit dollar terms. From the March 23rd, 2020 bottom, they've been 20+% in India, in dollar terms, I believe. But forget, that was the bottom. Take it from Jan 1st to 2020 and they're double-digit dollar terms. So if COVID couldn't cause any damage, Trump is with all due respect to Trump, he's no match to COVID.
Yeah.
A taper tantrum, if you remember back like more than a decade ago. This is just like Trump tantrum. What damage really did taper tantrum cause at that time? That was the biggest issue, right? Bernanke mentioned something about tapering. And markets all across the world. So every year, pretty much, you go back, how many ever decades you want to, look back, every year there'll be some major sources of concern which would make it appear like this is the most uncertain time in the world, but it's just normal.
Okay, fair point. And thank you for that. It's interesting food for thought. Prashant, I heard you say that you refrain from taking currency calls, macro risk, etc. One point that I would want you to ponder, and I would force you to ponder a little bit right now for our viewers, because that's a thought that is coming in a lot of people. Nobody can predict that, but people are saying that there is a case for the dollar index which has been strong for so many years, right, to now weaken, because a lot of other areas are putting up capex and the US has idiosyncratic issues of its own, if you will. And if so, could the hypothesis be made that the DXY or the dollar index or the United States dollar will weaken against a basket of other currencies over a period of the next 2, 3, 5 years? And could that mean that flows, which in the case of higher rates and dollar exceptionalism were moving to the US, would start moving eastward to emerging markets?
No, certainly. And look, these are certainly very interesting topics, whether or not we let them reflect in our portfolios. But I will just give you a caveat that I have zero confidence on my own views on these topics.
I do. Yeah. So that's why I'm asking you.
So, and I usually play devil's advocate. If you ask me the other way around, I'll give the other, justify the opposite. And now I'll try to play maybe both sides or devil's advocate. I do think that US is and would remain in, everyone knows it is the reserve currency of the world. And I don't think there is any challenger to that in our lifetimes, at least.
Okay.
Yeah. The only very distant challenger that I can think of as things stand today and everybody would laugh at it. And my clients, when I say they laugh at it, because today they themselves are not prepared or thinking that way, would be India someday. But as of now, unless China changes, and no authoritarian country can ever have a reserve currency, in my view. So China has the democracy, China has a capitalist market, and the strongest military in the world. I think combination of these three are required. A democracy, well-functioning democracy, which we do have, a strong or amongst the strongest military, which we also are getting there. Now, obviously, you'll have strongest military when your economy is very large.
Yes.
There could be other capitalist countries with democracy, but their economy just isn't that large to support the largest of the militaries. Yeah? So we have that. A capitalist system is what US has as well. It's not, let me correct myself, it is not a capitalist system, but it is more capitalist than most other countries. The other capitalist countries as well, like Singapore, Switzerland, but they don't have the size of military, if you will. But obviously, Swiss currency is also very strong, not a reserve currency, but very dependable currency, if you will. So this three combination in our lifetime isn't changing. And I think, yes, there will be ups and downs in dollar. Those are impossible to predict over the coming few years. Just as till December, it seemed like there's no way for nowhere else for dollar to go but up.
Yeah.
There have been few weeks or months of a bit of a weakness that may reverse starting tomorrow, depending on what Trump says from the Rose Garden, right? So we'll have to see. I'm not bearish on US or the US dollar. I think regardless of whether we like Trump or not as a human, I do believe he'll be good for the US markets, for US corporates and US markets, and quite likely for US economy as well.
Okay. So what happens to flows, Prashant, to your mind? We have this big spiral of domestic flows that has gotten unleashed the last 4 years.
Absolutely.
Is that a sufficient condition? We know it's a necessary condition.
Sorry, I didn't complete my answer to yes,
Please.
you had asked about that. So again, it is impossible to predict one, and that is because it is impossible to predict the market. If you can tell me what the markets would do, I can tell you what the flows would do.
Okay, fine.
So if the US markets remain in a funk like they are right now, if we are 6 months later, US markets are still, treading water, and they don't even need to further underperform emerging market. They're underperforming by 12%, 10 to 12% year to date. People love to see year to date numbers, all investors around the world. So if as long as emerging markets seeming to have done better than US on a year to date basis, I think we've already seen a little bit of a shift happening. Whereas at the start of the year, in January, there was a massive shift from all around the world, from every asset class to their corresponding or other asset classes in the US. We have already seen these investors and clients and their advisors pausing all the questions are being asked about US. And we've seen some positive outflows in India as well. And I think partly it is that phenomenon where US has underperformed, and hence questions are being raised on US. And hence there's money because net inflow is a outcome of two, right? Gross inflows minus the outflows. So even if outflows stop, then it turns, the gross outflows reduce, then the net inflow becomes positive. So that's what I think we've seen in EM in general. And to then summarize the answer, if US markets don't rally back and remain where they are or sideways compared to emerging markets, we should see money flowing back to US and India and EM. But if US markets have a rally, the reverse would be true.
Got it. You're not going out and predicting that right now. You'll wait and watch. You will follow the market.
Well, it is a function of the market.
Sure.
So I think there's a big myth globally that markets are driven by flows. I've always believed that flows are driven by the market. Narrative evolves. Market ka rukh dekhkar. The stories are, stitched.
Got it. Okay, fine. Okay.
So it is like the market creates the perception of reality.
Okay. Let me try this stack then. first half of FY25, growth in India suffered. There was maybe less action. The RBI had its own moves. I think there seems to be a concerted effort, both from the fiscal and the monetary side in India, to give a push to growth. RBI is doing its bit, the government is doing its bit, PLI, etc. Do you think we come off this quagmire of low growth that we were in for the first 2 or 3 quarters? And can FY26 or the remainder of 2025 show growth and therefore attract capital back into the Indian markets?
Understood. I would just say what would attract capital market would be the market itself if it does well. It's not necessary that market would do well only
the
if economy does well.
Sure.
Like COVID, economy did terribly, but market did well. And everywhere. So there's a caveat. But
sorry, यहाँ पे लग रहा है, right, that the market was not doing well because the economy was really misfiring. नहीं?
See, consumption was slow much before.
Okay.
But people weren't talking much about it because markets were doing well.
Okay, fine.
People would say कि ये short term blip है. But if market comes down, then people then start doubting whether it's short term blip or it's more prolonged. You know, mid-year में capex slowdown हुआ तो that was because of election. The market hasn't pulled back. That's why. Once market pulls back, then it seems more permanent slowdown. So I think that over the last 20, 30 years that you've been doing
Asking
and what
people,
I've been doing, average GDP growth has been 6%.
Gee.
But it's not been like fixed deposit 6%. Most of the time we've ranged 5 to 7. And every time it goes to 5, the worries do start. Right? Is it a new normal? And all. And जब 7 भी जाता है तो euphoria also sets in. Okay, we are now 8, 9 or 8, 9 पे also we've been
touched
for,
and
and stayed there for, due to confluence of events, sometimes you can stay at a higher level. So I think these ups and downs would be there. Sometimes we'll grow 0.5% slower, sometimes we'll grow 0.5% higher. I'm neither done the work or nor am I seen anyone do that work that can convince us, nor have I actually spent the time to understand whether the trend line growth for India has shifted upwards or downwards.
Okay.
We are making the assumption it is what it has been for many years. We don't see anything structural that has changed to suggest that India has moved off of that trend line growth of about 6%. And reality is, for the way we do what we do, even if it has shifted, it won't matter. But that aside, and that is why, since it doesn't matter, we don't spend time on trying to, and no matter how much time you spend, you can't figure out anyways. So that's the third aspect, right? So, but we haven't, right now, we don't think anything has changed to, move us from that 6%. Yeah, whatever post-COVID, we had some extra growth because we came from a low base. So those who thought we can sustainably now grow at 7% for whatever reason, I think they'll readjust. We haven't seen anything to suggest that it can grow sustainably at 7%. 6% odd is good enough to give us double-digit corporate earnings growth. Corporate earnings growth would be a little bit more volatile than economic growth, though that has averaged for the last 30 years that we show the data usually is about 12%. Because inflation, nominal GDP growth rate has been 12% during that time. Going forward, you assume because of somewhat lower inflation and slightly slower growth over a 30-year time frame, the growth has been a little higher, right? So 6, call it 5.5%, 4.5%, 10, and then take the compounding effect, little over 10% corporate earnings growth, throw in a dividend yield of 1%, low double-digit pre-tax return, high single-digit, just sub-low double-digit net of tax return, seem very reasonable from the market from where we are today.
You're making it sound awfully simple. I know it's not that simple, but it's good to see this arithmetic as well.
Yeah, and if you see if you see over reasonable time periods, it has played out this way.
Got it. Okay.
It's like India lost 15 coin tosses, I'm told, in a row across formats, right?
Cricket.
Cricket, man. Now, that's not what you can extrapolate. You still assume going forward, you can neither say we'll win 15 now to make it up 50-50, nor can we continue our losing. So over any stretch of time, like 92 Harshad Mehta bubble peak to 2004, we were still not positive return. From the peak, if you were to take, it took more than 12 years to cross that peak. So kuch zero or negative returns were there. But those you can't, invest this way. If you think you are at you have to, take some averages
Yeah,
over
yeah.
multiple time periods, and that's been most of the countries like US, European, with some exceptions, the nominal GDP growth rate has translated, plus the dividend yield has translated into equity market returns.
Okay. So I'm gonna for in this conversation I'm gonna leave tariffs out because उस पे बहुत बात होने वाली है. So I'm gonna leave that out. But I'm gonna try and probe. Since you're making it so simple, look at bottom up, try and understand this, and then marry the risk. So let viewers marry the risk based on, or listeners marry the risk based on how they think about this. But I'm trying to think of themes which are the most spoken about, Prashant, and would love to know how you think about it.
So just to be clear, it is simple in terms of earning the market return.
हाँ.
The moment you want to earn above market return, it becomes incredibly difficult.
Sure.
Yeah, it's like 50-50 coin flip mein lana is simple for anyone. But to get 51% strike rate is actually impossible in coin flip because it's a perfectly, in a fair coin. But in equity markets not being perfectly efficient, there's still some room, but it is incredibly difficult. So now themes is you asked about.
Yeah, but I wanted to ask you a couple of particular things first before
Yeah.
we get down to other things. So, the one that is most spoken about is the conundrum that people have around information technology in India. The Indian IT sector has battled Y2K, multiple other instances come out trumps. People say this time is different because of AI, maybe because of US slowdown, added the woes, etc. How are you thinking about it? It's a large sector, it's a job
Absolutely.
creating sector.
No, absolutely. So again, like we do with most such macro developments, we don't take an entrenched position on either side.
Okay.
A lot of people talk about investing with conviction. I think, or a lot is made out of it. I think we find it more beneficial to invest with doubt.
Okay.
Uh, or always, be skeptical of your whatever conviction you have. So that's where I would say we are with IT. We understand all the AI fears and everything, but have seen this movie several times in the past, right? With Y2K, as you mentioned. I remember cloud was something that was going to put IT companies, would eat IT companies' lunch. Yeah, digital, if you remember, now nobody talks that language anymore. Every company was otherwise, every IT company around the world was on their earnings calls quoting for a long while what is digital as a percentage of their total business. All of a sudden that's disappeared because at that time everybody was worried about digital. Now companies have started talking about AI, their wins in AI, and very soon they'll start talking about percentage revenue from AI as well until they stop talking about it, hopefully. We'll see. See, our view is that corporates around the world, let's take any large US bank. Can't name individual name, but let's call it ABM. ABM Bank. They have thousands of IT projects to be completed. They don't have budget for those thousands of projects. They allocate, say, 5% of revenues to technology projects. Now, 5% of those revenue can, out of the 1,000 projects, only cover, say, 50 projects. The next 950 will have to wait. Now, if AI helps cut down the cost in half, they are not going to say, okay, we'll only spend 2.5% on IT. They'll say, we'll spend 5%, but instead of 50 projects, we'll do 100 projects.
Okay.
They'll still have 900 waiting. And the backlog would increase because the new technology, that is AI, would create 1,000 new projects. So that is, I think, just as likely an outcome that AI would spur a lot of new projects. The bandwidth to spend still remains 5, 6 or whatever percent. And if ABM spends, then their counterparts, all their counterparts would also have to spend. Yeah. So that's why I say Y2K mein people would say, oh, 80% or whatever, large majority, let's say 60% of the tech spend for JBM ABM.
ABM.
Sorry, I'm getting close.
Completely fine.
ABM is on Y2K projects. So next year the budget would be cut in less than half. That never happened. It's just that in that year, ABM prioritized
Something else. Yeah, sure.
Y2K projects, and then all the projects came back on track. So that's our view that spending overall isn't going to spend. Can there be some hiccups? Yes, which are impossible to predict. We actually, our team did a great job in 2018 where there was all this fear around digital and all that. Some of the best execution machines in IT were spending at low double-digit multiples of cash flow, not earnings, 10 to 12 cash flow multiple, and then delivered phenomenal returns. Again, we cannot assume that's going to repeat and go whole hog in these names, but at the same time, we are not ignoring them and continue to. It's going to be a possibly a volatile operating environment. In such volatile operating environments, companies with strong execution teams, strong managements and execution DNA can gain disproportionate market share. So this could be a time where companies with strong management capabilities actually grow much faster than their peers.
That's an alternate thought. I don't think people have said this. So good to know this, Prashant. Because the markets have corrected quite a bit. Yes, we've bounced back from the lows, but still quite a bit off from those highs. Are there pockets of opportunities wherein the valuation multiples relative to their growth, maybe they could be 10 to 12 times cash flow multiples, I don't know, but relative to the growth in the offing, are there serious opportunities on the table currently, or were the markets anyway so expensive that right now they haven't become cheap despite the correction?
No, great question. And we see on an ongoing basis, there's always daily something we're buying or selling as a team. I would say the pockets that were, the market is, as you said, barely, it's not like a bear market or anything. We are probably, depending on which index you're talking about, the smaller caps have done worse. Nifty year to date is like flattish to down 0.5% or something. So within small caps as well, there's certain pockets which are down 30, 40, 50%, but they were the ones where they had got overstretched. And now they've come back to maybe closer to what are more normal levels. As a basket I'm talking about, within that some more, some less. Yeah, certain sectors like consumer, the last several years, haven't seen any. Yeah, so in the power sector, in the manufacturing sector, in the defense sector, there was that extra euphoric assumptions that were built in. That froth has been taken out. Otherwise, see, anyways, all the time there are names that become very attractively valued, even in the absence of massive correction. And with the correction, you're right, there are some segments, particularly I'm thinking about stock specific. So let's say capital market intermediaries. Some of them believe have been beaten up as if capital markets aren't going to grow again. So when on the team also we discuss, people have become more skeptical. Okay, let's assume a flat market from year to next year, 2 years. Like, how can you assume a flat market? From today, you cannot assume a flat market. Yes, from 3 months ago, okay, you can assume a flat market, the markets are down 10%. So some of these companies where the assumptions have turned very cautious, yeah, there are opportunities, no doubt. Some of the industrial companies where because of a little bit of lull in the capex, the assumptions have become very cautious. Yeah, so there we do find opportunities on a specific basis in some of these sectors.
But the MNC ones would never be cheap, right? So they have become cheaper than what they were, but they're not technically cheap.
Yeah. So MNC ones in the industrial sector, some of them have pulled back quite a bit.
Okay.
Obviously, they had gone up like that as well, and there are again select opportunities there as well. Whereas on the consumer side, they had never participated. Some of these leading consumer names are barely up compared to 5 years ago.
Agree.
And massively trailed the market.
Yeah.
So MNCs as a basket tends to be less volatile or a lower beta. So they haven't pulled back as much, but they'd also not gone up as much other than the industrial sector.
Got it. Yeah. Actually, so before I come to capital markets, since you brought this up, staple companies. And we speak to a lot of home-grown, India-grown, small food companies, staple companies, who are innovative marketing, specific pockets, catering to urban class, higher margin, etc., maybe, or rural specific pockets, and are eating away the market share of the long established distribution chains of the pan India players. Can more and more of this continue, and therefore would large staple companies consistently see their margins and profitability metrics getting eroded, and therefore multiples coming off? So they may grow earnings 6, 7, 8% every year, but multiple नीचे आ रहा है, इसलिए भाव नहीं बढ़ रहा है. Could that be the template for the next few years as well?
No, could be. Their multiples have come off quite a bit over the last 5 years. If you look back during the period of 2003 to 2008 time frame, when you had this infra real estate commodity boom, they had seen quite substantial multiple compression at that time as well. And for the entire bull run, they missed that bull run out. Again, they missed this bull run out. So what you're saying is possible that there could be further multiple correction. Impossible to know, but it is possible. What you're saying as a phenomenon is happening, though it was happening back then as well.
पर मैं आपका hypothesis पूछ रहा हूँ, मैं बोल रहा हूँ ठीक है. What is your thought? You understand this far better than most people.
So see, again, as a sector, I would not make that call that
A sweeping
consumer
call.
staple companies, it is fair to say at this time, our team is finding less opportunities in consumer staple segment, meaning that the allocation is somewhat lower than the market averages. Yet within that, we will search for whatever is the best within that and invest. And then some are doing better job at innovating. Some have a longer tail of products that are yet to, gain the market penetration. Some are more penetrated. Others are just taking off. And then compare that to valuation, you still find some opportunities in staples as well.
Prashant, you manage large pools of money. Surely capital markets and industrials can't accommodate everything. So where is the highest overweight and where is the highest allocation, the top 2 or 3?
Certain. So see, structurally, we have not from a top-down view that this sector would do better or the other, but because the construct of the sectors, we tend to have higher allocation in certain sectors and lesser in others. So first of all, we have 2 key biases in our portfolio. One is size. So we'll have greater allocation to small and mid because they're inefficient segments of the market. We do not believe ever that small caps would outperform large caps as a benchmark or index. But because they're more inefficient segments of the market, we can extract more alpha. So benchmark return is the same for large and small. If we can extract more alpha, we can generate higher return in small and mid caps. So that remains the case. We have overall higher allocation to small and mid, which we've always had. Second, and so first of all, if I take this small and mid, there are certain sectors which are more small and mid cap heavy.
Right.
Like consumer discretionary, industrials, healthcare, as against, let's say, energy, banking, which are skewed more towards. So that aspect would tend to favor certain sectors. Second, what skew we have is that of governance. Tend to have, I'm not saying we are looking only for AAA governance or anything, but on balance, our portfolio tends to have better governance than weaker governance. Now, there are certain sectors which tend, and there's no such sector where every company is,
of course,
good governance. So 80-20 rule does apply. Not to name any particular sector, but I think one sector one can comfortably, or worldwide investors tend to agree, is real estate as a sector where, governance leaves a lot to be desired. Again, at the risk of generalizing, and a lot has improved over the last decade or
but
two.
Still, yeah.
But I think nobody takes offense. Real estate managements are the last to take offense because they believe other than them, everyone else is a crook. So let's say real estate as a sector. So we'll tend to have the 80-20 rule. There'll be only 20% of the real estate basket may be eligible for us to invest.
Got it.
On the other hand, let's say IT services with some exceptions. Yeah, and they've happened in the past as well.
Yeah.
You can say 80% of the IT services companies or more Governance wise, there isn't a problem. So we'll tend to have a little bit more skew towards
Got
it.
it. Okay,
So on those basis, we have large allocations in the portfolio across. Would be fair to say in larger cap lending institutions, financials, banks, and NBFCs and all. Mid cap technology, IT services companies. I was talking about strong execution in healthcare, not just across market cap, I would say in healthcare, but more particular in the small and mid cap area in healthcare. Healthcare is a very rich small and mid cap segment. Then consumer discretionary, so not staples as much, but in consumer discretionary, there's the largest variety of business models.
True.
It's a very heterogeneous sector. Yeah, so these four and some selectively then industrials as well. So large cap financials, mid cap IT, small and mid cap healthcare, industrials again small and mid caps, and fifth one was I forgot consumer discretionary.
Consumer
That
discretionary.
again is a lot of small and mid caps are there in that space as well, and large caps as well.
Got it. Okay. My final question on this conversation, Prashant. And where is the largest risk for Indian markets for the next 2, 3, 5 years? Could it be? I mean, I'm giving you choices, and you could have an answer of your own, of course. But the 2 or 3 that I thought of, or maybe more, but one is: would it be in inward-looking risks that growth slows down or policy doesn't fire, something like that? Or could it be that other nations are making such rapid advancements in technology that India is left behind on that? I mean, we don't hear India's name coming here in semiconductor or AI, what have you. I mean, China is really bucked up. India has not quite shown that promise. Could it be that? Could it be global geopolitics? Or could it be just that newer avenues coming up? Nobody thought of Germany as a big investable market. It's come out of the blues and really shining through. So what could be the biggest risk to Indian markets, relative or absolute performance?
I would say the first one. I don't worry about the second or third at all.
No?
No, I don't think in technology, which like internet, we weren't the first ones out there, right? But we caught up over time now to be amongst the cutting edge. Think about computerization, the buzzword in 80s. We weren't amongst the first one. Telecom, we were probably amongst the last ones in telecom, right? Obviously on wireline side, we were the last. I remember in 90s or late 80s, still late 80s, our penetration was 1% or something. Yeah? And even in wireless, we very, very late stage, later years that we caught up with the penetration around the world. So technology, I don't worry. At least historically, it's not, stopped us. Because it's a delta that matters. Yeah? And delta, there's a lot of deltas in India. We are still under penetrated in a lot of things. So the delta helps in attaining that 6% growth. Third one, geopolitics is impossible to, if there's some kind of a war-like situation or a pandemic-like situation that affects everyone. So if it is country-specific, what can affect India would be the first one. If the policy that markets, like investors around the world and Indian investors also have come to expect a certain policy continuity. So you saw the huge volatility around the elections last year. That didn't last for too long, but for the few hours that it lasted, it was extremely volatile because that was the brief time period where that assumption of policy continuity came into question. So either by for whatever reason, if there is a challenge to that assumption of policy continuity, that to me would be the biggest risk over any time period as of now, what I can foresee.
Wow. At the end of this conversation, I'm feeling that for a large money manager to look at things in such a simple, bucketed fashion is fabulous. So quite amazing to talk to you, dear Prashant, especially during these volatile times. But as you said, they've always been this way.
Only way to remain sane. Thank you.
No, thank you for talking to us today.
Thank you, Niraj. Thanks much. My pleasure. Always a pleasure to speak to you.
Likewise. And viewers, thanks for tuning into yet another fabulous episode of Talking Point Unfiltered.